Dr. Chow, for when you take the exams, do you take both the papers at the same time?
I did.
You did?
There will be a half 30-minute rest,
Okay.
but you're prepared enough for this paper you can take at the same time. But if you want to take it one at a time, you can take one paper on first and the other one after. They will come here to come.
Okay. And the exam is done here?
On the Qualification. No, only the AIA headquarters.
Okay.
6-floor training room. Okay, this part is long-term insurance. Basically, it's life insurance part. That's not very complex. And again, there are 5 sections. Each is equally important, so you cannot escape any part of it. Only 50 questions and 70% correct. So pass. Only relatively is easier. If you take
1 hour 15 minutes.
Yeah.
Right.
Enough time. Not only enough time. Definition of insurance. There are 4 parts of it: needs, correct, savings, investment, and retirement. And can be tailored for personal needs and business risks. Personal needs, so we have these categories: living expenses, final expenses, educational funds, retirement funds, mortgage repayment, emergency funds, disability income. Business needs, key persons, meaning the key directors, shareholders of the company, because among them there are insurable interest. It's the individuals and the business companies. And business owners are the same, partners are the same, and only employee and employee benefits is also have insurance interest. So the principle of insurance, as I reflected in the part 1 paper, there are 6 principles: insurable interest, you've seen it, utmost good faith, proximate cause, indemnity, contribution, and surrogation. 6 principles are very studied. And this one will explain what insurable interest is, and you already know it. Insurable interest, a contract is void if it has no insurable interest. It's not voidable, it's void, it's valid. What is insurable interest? Yourself and your spouse is insurable interest because husband and wife are considered as one entity. Your children under 18, but if it's out of not out of blood relationship, it's also insurable. Let's say your second wife, your is also insurable, but also your business partner, because of financial consequences, a contractual relationship with your employees or your key person, key partners, key directors, also insurable. Debtors also have insurable interest on yourself. All right. And what is the interest about? Interest is about when the contract begins. When the contract begins, insurable interest is needed. But when the contract started, let's say you have a policy with your wife, and your wife is your insured, and you're the proposer, and you divorce, the policy will not become invalid until you change the insured or the beneficiary. Okay, they're still valid after divorce. Assignment is to assign the interest of the policy to another person. When the policy owner becomes the assignor, and the other person becomes the assignee. Let's say this other person is a debtor. You assign it to the debtor, become the assignee. You transfer all the legal rights from you to your banker or your debtors, your assignees. And the notice, the assignment must be notified, must notify the insurer. If it's not notified and the insurer do not know about it, when the assignee tries to claim, the insurer says, I would not not honor the assignee's rights. No.
Right.
The rights of an assignee cannot be more than the assignor. Any overdue premium should be still payable. He received only the net proceeds.
Okay.
Assignment of benefits, not the rights. You can assign the benefits, the cash value, but not the rights to pay the premium to the assignee. And transfer your duty. Limitation of assignment must not violate every vested rights of the beneficiary, must not for illegal persons. A lump sum payment of policy benefits to the assignees. No further explanation. No further. Assignment can be permanent or can be temporary. If it's a permanent assignment, all ownership rights for the life contract will be given to the assignee. This situation can happen in two ways. One, if you borrow money from your bank, if you're a business owner, you borrow money from the bank to run your own business. The bank say, "Oh, I'm so worried that you die, your business will fade, will be result in loss. So I will ask you to buy the insurance company and assign your death benefits to the bank as a protection, as part of the security."
Right.
It is permanent. And these assignments will be released to you, be reassigned back to you, and you fully pay it off.
Got it.
Okay, this is one part of the assignment. The other assignment is to right now there is a popular term called reverse assignment. That means you assign your death benefits to the mortgage company and give you a commitment that will give you an annuity. Money you pay, monthly recurring income to you. So when you die, the policy benefits will go to the mortgage company, and they will give you back the remaining portion of your money to your successors. And it is called, and also this happens more often when people are becoming older and have no money for the life policy.
Right.
And the assignment can be, the collateral assignment can be signed as part of an entire can be a collateral part of the security to give the banks, and then will limit the assignee's interest only to the loss of the loan itself. But more than you assigned a portion of your death benefits to the bank, sign up to amount of the popular assignment. But most good faith, we explain that.
Yeah.
Material facts. For example, is on medical application, medical information, and you must take a test has the right to know the facts before they step or not affect premium. Other principle, this all premium already knows and how they put into practice. For life insurance, the cost of death is not critical. Whether you die of accident, whether you commit suicide after 1 year, doesn't matter. It's still paid. But for non-life, the peril, the risk that you insured is important. For insurers, cost of loss, which are neither included or excluded, so it's very important for you to consider. For life insurance, there's no indemnity contribution surrogation because it's not paid out of indemnity, it's paid out of benefits. But general insurance is paid out of indemnity. So all these principles will apply, but not indemnity. Factors according to the level of premium, how much the insurance company charge you based on 4 factors: the interest rate, the mortality rate, the administrative market expenses, and the other factors. The cost of insurance. And the cost of the insurance is higher in China than in Hong Kong. So if the same person, same age, the life is shorter in China than the premium is higher in China. So that's why a lot of Chinese people come to Hong Kong to buy insurance. They will administer the death mortality rate according to Hong Kong. So there are the premium that you charge through and composed of three components: the mortality rate, the death, the risk of death, the interest, and the possible and expected expenses like the marketing expenses, education expenses, the incentive given to commission given to in an insurance agent. All of them compose the overall premium rate. So when there is a discrepancy, sometimes higher, sometimes lower than this expected rate, this is calculated by actuary. If it is higher, it means this product is no longer profitable. They will stop this product and introduce a new product. Then it's lower than the predicted rates, then this product will be very profitable and they will give you back as a profit or dividend, sharing of the dividend. Factors: competition, public health, economic changes, like the interest rate changes right now. A lot of AIA policy has to be stopped and be reintroduced as a new product.
Right.
And par and non-par, different terminology. UK, British system called it profit. US system called it par and non-par. Profit, par, meaning profit sharing. And profit, we have two terms. One term is called reversionary bonuses. These are the annual bonuses accrued by the actuary based on their forecast expected total premium cost and the actual premium cost. There is a surplus we call it reversionary bonuses, which will be shared by all the some of the policy owners as additional. How are dividends paid? Is paid out of cash, paid out of used to pay for additional insurance or term insurance, for them to earn the interest called the terminal interest. So AIA policy have two bonuses. One we call reversion bonus, which is declared annually by the actuary department, subject to the government's supervision, and the one is a terminal bonuses, which only give you at the end of the term mature. So dividend options can be used to pay additional insurance or keep in the accounts for further income. Level premium, that means your mortality will go up, but we charge you at a level premium. We take a look at the first. Policy loan is to assign the policy to the insurance company to borrow a loan. Normally, this loan will come with an interest. Right now, they have 6%. Grace period is a period when the premium is due and you are due to pay. But for next 31 days, your policy is still valid, and time you can pay the premium and still keep your policy alive. But after 31 days, your policy is elapsed. Does not pay your premium, do not fill up your policyholder's obligation. And after 31 days, this is not a free period, meaning that although your period is due, but you have not paid it, and it's not considered lapse, but it's a grace period. When you pay with this 31 days, the insurance company will take your policy live as live from the last annual date. But if you let's say you die within this 31 days, the policy is still valid. The company will still pay you the benefits, but they will deduct the premium. But if you pay after 31 days, you have to apply for a procedure called to revive your policy. Then, if you revive policy, the company has the rights to ask you to go through examination, medical examination. Okay. Every policy has a cash value. I mean, life policy has a cash value. Normally it's zero. The cash value is zero in the first 5 years. After 5 years, it accumulates some value. After years, you will pay for the commission, for incentives, for everything, for the insurance company, marketing, and business expenses. Okay, so if you surrender, meaning you give up your policy in the first 5 years, you get no money back.
Right.
And after you paid, after certain years, you can reduce the pay of insurance amount, lower your face amount of protection, and you reduce the premium. You can also extend the term of your policy as long as you have enough cash value to pay for your premium in the future. If you do not pay your premium, and this as a known for future benefits, you can pay out of your premiums at your cash value, and they will deduct from your cash value accounts to pay for your premium as long as there's money in your cash value. Reinstatement, meaning the policy to revive after elapse 31 days. For reinstatements, they have to be in ability, meaning that you prove that you're good health, and you can repay or pay back the premiums, etc., etc. They may charge you a reinstatement fee,
Right.
and all your contestable period, all your waiting period will recount after you reinstate. Settlement. This is easy. I want beneficiary, name beneficiary, revocable beneficiary, and irrevocable, meaning whether you need to change your beneficiary name or not. Can be a named person or can be a class of destination. All my children. And death benefits paid out your first beneficiary, conditioned beneficiary. And right now with policy, we have a second insured person. You can name 2 insured persons. Right now, a new policy. You can name your first, your wife is the first insured person, but if she dies, if there is no second insured person, the policy will terminate. It will pay out of the policy. But if the second insured person, the second in person can substitute the first person, then the policy can still continue. Suicide, there's a period where the suicide will is not payable. If you die within 1 year, please commit suicide in 1 year, just refund the premium to you. After 1 year, even though the suicide is still pay out the debt. Incontestability, I mentioned that. An insurer will not contest the contract, meaning do not cancel the contract if you have been in force for the insurer for 2 years in the living years. After 2 years, they will not. Even at any event, exclusion of fraud, if they misrepresented, if they just cheated the company, that's any time, even after 20 years. But if it's not out of fraud, out of forgetfulness, minor things, they will do not. Types of insurance. This is a very interesting part. There are 4 types of insurance. Life insurance: traditional, non-traditional, annuity, and groups. I assume you know some of them. And just focus on the ones that you do not know. For basic variation, we have 4: convertible, renewable, par, and non-par. Meaning participative, non-participative. Participating means participate in the profit sharing of the policy. Non-participative, there is no sharing of the profit. Riders, additional contracts attached to original policy. Term insurance is for term, a limited time, for 1 year, 5 years, and the cover will terminate after the maturity period. Term insurance for a specific period of term only. For term deposit, for term insurance, you have level term, meaning that the amount of insured will remain the same for the same period, or increasing term, increased by 10% every year, or decreasing term, reduced by 10% every year, reducing it, the protection amount according to your mortgage, loan outstanding, something like that. So it can increase, decrease, or level. Can be renewed or convertible. Convertible, that you can convert to other type of policy.
Right.
This is easy, so I would not. So increasing, decreasing, and this family income benefits to the family members is a decreasing term. So 3 types of insurance policy are decreasing term. Credit life is decreasing because it's on group basis, provided to all the borrowers, a group of borrowers. So that when borrower repays, amount of protection will be low. Mortgage, according to your mortgage loan outstanding to the bank. And some of them are increasing tied to a 5% increase over time every year, or decreasing 5% or level, protection amount remain the same for the next few years. Renew every 5 years, it can increase, decrease every other after the age of 60 or every 5 years. Convertible, you can convert to other permanent plans. Endowment. Endowment is a term plus a pure savings. So the amount of money will be repaid to you as long as you are still alive as a future. That's called endowment. Whole life, face amount is paid on death only when you die, and the level premium is a premium level, same amount of premium. It could be par or non-par, participative or non-participative. And how good is it? It is good for transfer of wealth to your generations. So it's only paid when you're dead. The premium could be throughout the whole life, limited period, subject to an age. Variation, whole life can be graded premium, whole life. The premium can be increased every 3 years, so that's very simple. Just a design of the policy. So look at this traditional policy term. Term life is very useful when people have lower income or have lower premium that they pay, lower cost to them, but they have higher protection amount. They use term. Renewable or every 5 years converted to other long-term savings, credit unions. It's a good product to use for the younger people. Right. Endowment for people to save for the future. For whole life is money that they continue to pay, they will still enjoy. They will serve as a reserve of money for people for retirement, and also to protect the life of his family. And that is how it is used. A non-traditional type, there are 2 types, one called universal life insurance, one called unit-linked long-term insurance. Universal life meaning the amount of protection is variable, the premium is variable, everything is variable. The payment, the premium is variable. So it's called universal. You paid in a large sum of money and then you take it out. You can increase your protection amount, reduce the protection amount. So it's very flexible life insurance. And the insurance premium is calculated on the actual insured amount. It can be vary from year to year.
Right.
And unit-link is your benefits is linked to some fund management. So the amount of premium is variable, and your benefits level is also variable linked to your investment. And universal, they will calculate the cost of the protection, the interest, and deduct the expenses, administrative fees, and give you the cash values. Annuity, you know what it is? It's give you a sum of money for the future. Yeah. Redesigning your cash flows in the future. So you have lifelong annuity or fixed term annuity. immediate annuity, deferred annuity. Deferred annuity is only deferred. You literally would start at the age of 5 or 70 years old. It's a deferred annuity. Right now, Hong Kong provides a tax benefit of it if you have a deferred annuity. And you can pay up to your life ends or up to a certain period, or up to the death period. So this is a reclassification, traditional, non-traditional. Non-traditional, two types, universal. AI has both products on this too. Annuities, we have immediate annuity, deferred annuity. We also have these products. Group insurance happens for single employer or multiple employer groups. It provides a group benefits. The benefit of it is you do not have two individuals for medical examination because you take an average of the group composition according to the age and calculate a premium rate for the group, and they will enjoy the group benefits. And I also have contributory. That means you participate in the premium and you do not participate. The employer pays all the premiums. Okay, good. This is chapter 2. Then chapter 3 talks about benefit riders, and you have these are the riders, meaning disability. Disability is you lost one arm, one leg. Accident is the cause of death is by accident, something you cannot control. Accelerated death benefits is death benefit. Medical benefits for you to pay the medical expenses. Insurability benefits and flattering adjustments is the adjustment to the cost of benefits and the cost of your hospital income, something like that. Total disability is an essential act that affects your duties or job, and you basically cannot do anything after those total disability. Lots of sight, lots of arms, lots of feet, both hands, both feet, and you become lost on one hand, one foot, is total disability. And you can waiver of premium. There's a rider that means you do not need to pay your premium again. You can have an income up to 2 years, 6 years of you become disabled for over 6 months, and you're entitled to disability income. And this will be for a period for a lifelong. Income benefit can be paid after monthly for a period of 1 to 6 months for the total. Accident, we call it AD&D. Accidental death is dismemberment, meaning loss of arms, legs, and other benefits. DB, death must be caused directly or indirectly by accident or body injury. So it's easy. Dismemberment, meaning loss of limbs, loss of sight, meaning total loss. And if it's not total loss, it's a percentage.
Right.
Other benefits, serious benefits, weekly hospital income, double indemnity. For other extra benefits, exclusion, meaning self-inflicted injuries, etc., war inserted, legal activity excluded, disease or illness excluded because it's not accident. Childbirth is excluded, accident excluded. So these are the accident plans, AD&D, and other benefits. Hospital benefits meaning income, hospital income, support the income. Right. Accelerated death, critical illness benefit, and long-term care. And we have defined 105 categories of disease as critical illness.
Right.
Long-term care, meaning that you have to rely on nurse, relied on the hospital care for the elders, then so on, long-term. Require medical conditions for daily lives. Critical illness, including terminal illness, or certain multi-recurring events, like with a couple of these. So most, most critical illnesses happen in most frequent critical illness in Hong Kong is cancer. and also stroke
Right.
or heart disease, right? And exclusion, medical expenses, benefits exclude pre-existing conditions. Meaning that you have, a week ago, I have one client to buy medical insurance and exclude all the skincare diseases. If the person has a breast problem, then breast disease is excluded. So pre-existing condition, pregnancy exclusion, drug abuse exclusion, HIV excluded, genital abnormal treatments excluded. Specified exclusions in medical benefits. Okay. Guaranteed purchase option, GIO. Guarantee insurable benefits, meaning that purchase an additional insurance to give you a right to purchase more insurance. Okay. For certain event. Let's say some of our critical illness plans can enable you to buy up to 50% of the insured amount at your age of, for example, 60, or when you get married, have your first child. Under that condition, within 6 months, you can buy high. I mean, you can increase your protection. All right. Limitation, meaning that you must exercise this option before certain age. Temporary cover, just a term insurance. Policy waiver, meaning that the premium will be waived if your certain conditions happen, like if your spouse passes away or parents pass away, a child passes away, certain conditions mentioned in the contract, then it's become a rider. Inflation adjustment, cost of living adjustment. So these are the categories of benefits. So we're done. Okay. Insurance procedure, something very new to you. 11 questions from it. And these are the policies, procedures, operations, application, underwriting, policy, insurance, after-sales service, and claims. Okay. Company operations. The insurance company have these departments. Accounts department, take care of accounting. Actuary department, calculate the premium rates. Agency training, provide agency training and exercise quality control on the agent's performance. Claims, handle the claim applications. Client services, doing the housekeeping for customer account change. Who's taking care of who's accountable for agents, for example. Marketing, promote developing new products, promoting advertising. Underwriting is to accept new applications, whether to accept or not accept. Mutual insurance companies, there are the mutual insurance companies and proprietary or stock companies. We are stock companies. We are companies. There are mutual insurance companies, which is a group, like a society type of thing. They insure among themselves. So these are the life insurance procedures that you can study. And I think, the cool-off period, that's something I meant to mention. When you sign a policy, does it mean that you will be accepted? The company receives your application, the underwriting department should look at the risk, health conditions, age limits, and then issue a notice, whether you have to provide further proof or give you an order for medical examination. From that day or the actual delivery, if you satisfy all conditions, they will accept it and deliver the policy to you. From that day, count 21 days. And the expiry date, the cool-off period, will start whichever is earlier between these two. Right. Long-term insurance. I think this part we can study. Right. Okay, let's look at some questions. Oh no, just you need to read ahead. Go back. We need to go back to the academy session. Now you get to the just corner. Get to the academy again. To some of you, this part, because it's 75 questions,
Right.
It may be difficult for some of you who are not entirely new to the insurance. But if you understand the products, paper 3. Then go to the examination and start. Okay. Check the answers first. 1 hour 50 minutes. Okay. Should give me check all the answers. Okay. Okay. So we ignore the Chinese part. Okay, this one. Man arranged no medical expectation. He has no intention to mislead the insurer about the health conditions, but if all the truth has been told, the insurer would not have provided the coverage. Later, the man died, and truth all comes out. Which of the following is not correct? Let's look at which one of them. The insurer can revoke the contract if it never occurred within the 2 years when the policy becomes effective. This is a contestability term. Which of the following is not correct? Not correct. This is correct, right? Because it's in contestability. An insurer cannot contest if death occurs after 2 years. This is correct too. If no fraud is involved, insurers cannot revoke. That's true. Insurers can revoke the contract regardless of what time of death. Yes, if it is fraudulent.
Yeah.
The contract can be revoked. The contestability do not count. Right?
No, but what it's saying is that this one is not correct.
This one is not correct. Yeah.
So insurer can revoke the insurance contract regardless what time of death. So they think they cannot revoke it.
They cannot revoke it because it's not. There's no intention to mislead. It is intention to mislead is fraudulent. Right. Then it can be revoked anytime. But it's not. No intention to mislead.
Okay, fine.
Then the intestability contract. Which of the following are business needs but not personal needs in life insurance? Partnership, yes. Key person, yes, because it's business related. Retirement income, no. Employee benefit, yes. No. So only 1, 2, and 3.
1, 2, and 4.
Gross premium is what kind of items added to the loading? Interest, mortality, and the loading. Gross premium is pure premium.
Yeah. We did this.
Which of the following insurance plans where claims arise when the policyholder dies earlier than the specific period of the policy matures? There's a term, there's a participating term insurance or non-participating term insurance. Which of the following insurance plans claims arise earlier than the specified period of policy? Dies earlier than specified periods. Okay. Non-participating, participating has nothing to do with policy benefit payout, right? It is how the interest accrued. A term policy is for a defined period of time.
Yeah, I understand.
Yeah, so endowment, it's the only answer. The insured in the group insurance is called group life insurance, persons incurred. Insured. It's all this is easy. This one is easy. Which of the following is not a feature of endowment insurance? When the life insurance arrives and the policy is set to mature, it's not, huh?
Yeah.
But this one is a feature, so this one should not be taken. Can be participate or not participate? Yes. Largely involve a savings component? Yes. The insurance benefits are only payable if the insurer is still alive and the policy is mature. Is not a feature. The insurance benefit only payable if the insurer is still alive and the policy is mature. Is not limiting. It's not a feature. Insurance benefits are only payable. The insurance benefit only payable if the insurer is still alive and the policy is mature. As only payable. Largely involves this one is correct, right? It's a feature. Participative is a feature. When the insurer survives, insurer spirit, the policy sets to be mature is a feature. I think this one is not a feature because insurance benefit
because it can be the insurance benefits can be paid
during
the period,
even before the period, but for less amount.
Got it.
So it's very tricky. Sometimes you have to read again, particularly though it's not a feature, not correct, incorrect, something like this. It's a tricky question. All right. The question is complex. A person purchases a residual residence unit according to the loan agreement. He has to pay the interest and part of the principal maturity for 10 years. The loan will be paid off in 10 years. The plan to purchase the cheapest life, he dies with the 10 years. The remaining balance will pay off. The bad balance is called a decreasing term. Right? Although the question is long, but not very difficult to understand. Strict life insurance belong to pays benefit only when the death occurs in the specified period. Pays benefit only when the accident occurred. Pays benefit as a fixed number of years. The insured's life must pay premium throughout his life until the end. Oh. Let's look at it again. Straight life insurance belong to pays benefits only when death occurs in a specified period. Pays benefit only when death occurs. Pay benefit after a fixed number of years or when death occurs. I think this is a tricky question. Pays benefit only. A strict life insurance policy can pay within the period, but not only when the period, not only when the accident plan, not only when death. So it's not only pay after maturity. Only this one is correct. Yes, very tricky question. The shortest period of coverage for any common term insurance in Hong Kong is 1 year. Okay. You cannot have 1 month. The policy is described as continuous premium, whole life policy, then it has the following. Only one premium is needed, not true. The premium's level through the term, not true. Pays premium for the life, even the sure die, not true. pays premium for the life. It is only a correct answer. Okay. Another long question. I think we did this. Yes, we did this. The typical disability waiver rider states that the policy owner is totally disabled and if the policy has been in force for 5 years, nothing to do with 5 years, the insured does not have to pay the premium during the employment period, nothing to do with employment. When the competitors will lower premium, the insurance fulfills only is totally disappears. Only this one is good. Right? So it's not very difficult. Let's take this complex. Other accident benefits with serious burdens, yes. The 2 weekly benefits, yes. Hospital benefit, yes. Double indemnity, yes. So that's not very difficult, right?
Right. You just need to do your study.
The incontestable period is 2 years once the policy begins to effect. 2 years later, the policy may be disputed because it may lost.
Right.
So, very straightforward. Let's look at more. A common life policy change is when change of address, change of beneficiary, change of policy, change of the above. Yes. Well, you can change. Policy owner, beneficiary owner, everything can be changed. Even insured can change. In making recommendations of dividends, actuaries will consider several points. Which of the following is not the considerations? Not consideration. International agreement, expenses of pool funds, economic outlook, equity between different classes of policyholders. This is true. You have to consider different classes because the money is in the pool. You have different, some term life, 20 life, endowment, whole life. So you have the different classes of and the time to get into the policy. Some have been in the policy for 20 years, some will only be for 6 months, so you have to classify according to the listings of the policy owner. They declare the dividends or the participation of profit. There's nothing to do with the international agreement. It's determined purely by the actual department subject to the government. In life insurance, a term best describing the necessary risk assessment process due to provision of insurance is not the right one. Straightforward.
Okay.
So, enough?
Yeah.
Good. You're pretty good shape.
Yeah.
You can test your knowledge by going through this your several rounds.
Yeah, once I submit the credentials.
To at least 3 rounds.
Sure, I will.
I'll be fine. Very good. So you can give me your credentials and set you up for 21st. Say something to our audience in the future.
No, this is great. Thank you, Dr. Chow. It was a fantastic experience. Thank you.
Well, thank you for coming. So that's the end of it. We completed 50 minutes earlier. And I hope this video can help those who wanted to study and help you in pass senior. Thank you very much.
Thank you.